Hello and welcome to Moneycontrol. I'm your host Nickey Mirchandani and you have tuned into IPO Watch. Today's IPO that we're going to be talking about is Sai Silks Kalamandir, which is one of the largest retailer of ethnic apparel, apparently big in South, is open for subscription and is looking to raise around 1200 crore. The issue is divided into two bits. That's the fresh issue of 600 crore and another remainder 600 crore, which is for OFS. The price band has been fixed in the range of 210 to 222 per share, and the retailer of ethnic apparel apparently is looking to utilize the proceeds for three reasons: setting up new stores, warehouses, and also for meeting the working capital requirement needs. But to know more about the financials, the strategy, the product mix, and the evolving parameter of the financials, we've been joined by Prasad Chalavadi, who's the founder and the managing director here in the newsroom with us, and also Bharadwaj, who is the senior vice president. Morning there. Straight up, I'm going to start off. Tell us more about the uniqueness of your business model, because you seem to be operating in a very competitive market. That's number one. What's your moat out there, and how do you intend to utilize the proceeds in terms of the number of stores? When do you intend to open those stores, and how long will the working capital requirement suffice? Your take on that, gentlemen.
So before that, I'll just take a couple of minutes to explain the history.
Sure.
So I'm the first generation entrepreneur. I'm a founder and managing director. Before founding this company, I was working as a software engineer living in America. So when I wanted to come back and start some retail, I have done an extensive research on which vertical of retail to bet on. So, I figured out this women-centric Indian ethnic, which is closely connected and associated with our weddings, festivals, and occasions, is the industry for me to bet for my future. And that's where, with the thought, we started off our first brand, Kalamandir, in the year 2005, with one store at 3,500 square feet. From in 17 years, we could able to scale that one store to 54 stores, that 3,000 plus square feet to 6 lakh square feet. Today, that one brand became four successful and matured brands, and the first 50 employees became 5,000 employees, and we work with hundreds and thousands of weavers, master weavers, and vendors across length and breadth of India at around more than 100 places. So the idea is to get into this business is to penetrate, because this business is totally dominated by unorganized and fragmented players.
Sure.
So from the beginning, the thought is to do it so professionally and organized way with the help of the systems, which is totally contrast to this industry. So since we have a good software background and management bandwidth, so we have created required systems and systems and tools and other process in place, so that we could able to scale. As you told, today we can proudly say we are the youngest company to become one of the largest player in this women's ethnic. Presently, we are focused in South, because in South we are there as a choice, because that's where your highest per capita and highest spending is there. And majority of what we sell is saris, because in South, saris resonate well as an ethnic, accepted as a most of a ethnic attire. So that's the reason why we sell saris as our major portion. 67% of what we sell is saris, and rest of 33% comes from our women's other categories, apparels, and menswear and kidswear.
Software background, but still limited e-commerce presence.
He will try to.
1.3% is selling from e-commerce businesses revenue as a percent is just one and a
No,
half,
we
despite
know.
having that background. So that is a bit surprising. That's
No,
A.
Okay.
And B, what is your competitive moat that you have, the credible moat that you have? Because it's, as South as a market, which apparently is known for that apparel. How you distinguish your products vis-a-vis other products within that region?
Sure, sure. So firstly, to your first question, why e-commerce? I think the e-commerce journey for us started in 2020, when the COVID came and everything came at a standstill. We started quickly ramping up our digital presence, and the way we did e-commerce is also quite different. So rather than putting up our products on the websites and calling it as a e-commerce presence, what we did is we started creating content around it. So today we use digital platforms such as YouTube, Facebook, Instagram, and whatnot. We bought in celebrities, we bought in influencers, we bought in anchors. So what they do is they go on the camera live and they explain the sari in real time to our customers. So that is what we were able to create. The closest experience to touch and feel was that. So by creating that amount of content, we are able to slowly grow there. Having said that, our e-commerce presence today is less than 1.5%. Now, the industry as a sari as an industry has always been dominated by a touch and a feel factor, because a lot of these fabrics, though we call fabrics, there's a lot of colors. So just in red, there are 10 different shades of red. There's a silver and zari mix that gets into it, and which is very difficult for the e-commerce presence to reflect those colors there. So this has always been a tradition where a typical sari buying, if you take a customers, they come in groups. They come in like 5-6 people. They sit, they select, and we need to show a large variety of options.
To change that anytime soon?
Our e-commerce
Let's
growth,
put it that
our
way.
e-commerce growth is a steady state of growth. We project about 20% of growth, but however, our offline presence is always dominating, because we plan to expand very aggressively in the offline space, because we see a great demand coming henceforth. Now, talking about our moat, there are 3 to 4 reasons why
So that
we believe.
1.5% goes to how much and in how many years, if at all?
I don't think I should be talking about in future, but we see a very good state of growth. A 2-digit figure growth is what we can expect.
And that's double digit is expected by when?
Year on year is what we can expect, a double-digit growth. Every year we can expect a double-digit growth.
Oh, to the mix, the existing mix, there is a double-digit growth to your e-commerce side of the revenue.
You're right.
That's quite a math, but yeah, we're going to go back and check with you on what exactly is the product mix now. You said 67% apparently from the women ethnic wear, and the remainder 33% coming in from the other kids and men category. Would you like to change that product mix? Do you see that changing anytime soon? The reason why I'm asking you this question typically is your ROCE of 23% seems to be at the lower band as compared to your counterparts. Would you change that? Do you expect to change that anytime soon with the change of your product mix? How are you looking at it?
Sure. So if you talk about our product mix, it's a 66% and a 33% split, as you rightly said. In these markets where we operate, we see a great demand coming in from saris as a product, and there is a thorough exercise that we do when we're trying to put up a store. We do a market survey, and we do a proper target market fit and a product profiling for each and every store, and that's the resultant of how a typical store would be having a mix of about saris and other women and apparel as we speak. So now currently what we are trying to do is like we're entering into a Tamil Nadu market which has a higher potential for saris being sold, because Tamil Nadu as a market has a combined potential of almost close to Andhra and Telangana put together, and the per capita consumption of saris is also something which is very, very dense. And the market also suggests, because we already have 4 stores currently as we speak in Tamil Nadu, and these stores are doing well above the company's averages, well above the format averages, and that's the reason why our go-to format in the near future will be majorly playing in and around saris. And talking about your ROC as a mix, the strategy of the company has always been to sharp razor focus. We always believed in value for money. If you look at our A&P expenditure, it's less than around 3%, which is much lesser compared to anybody else. And specifically, if I have to talk about our Varamahalakshmi Silks format, in the history for the last 12 years, never in the history we have done end of season sale, discount sale, or any bargaining or something. Nothing of that sort happens. The reason we are able to do that is because we always price our products for value for money, and that's why you don't see a big margin and then you do a clearance sale or something to liquidate. And these margins is something that we carefully calculate, because our throughputs is not in percentage values, but we also see in rupee value. We are doing much better. Not talking about the names in terms of the competition, but in this particular space, especially in the sari retailing, I think it's safe to say that we are doing pretty good.
So coming to your coming to your question on betterment of ROC down the line. So if you look at our future expansion from this IPO proceedings, so we will be opening around 30 stores in the state of Tamil Nadu, which he explained the most potential state. And that too, out of 30 stores, 25 stores with the format of our Varamahalakshmi silks, which is the more than company average. And with that background, again, the region, the Tamil Nadu, which we are going to penetrate now with around 30 stores, which as a historical that also have highest yielding in that state. So with our highest yielding state, where we are going to penetrate with our highest yielding format, I think you can calculate the ROCs how it will be down the line.
Correct.
Do you want to add a number to it?
No.
Okay, Mr. Prasadji, since you said that you don't want to, so I was like, might as well give a projection.
We can definitely see improvement. That is something that we can say, because
Sure.
Prasadji,
Prasadji, I would want to quickly ask you, so now the ROCE growth driver will essentially come from a new geography and not new product mix essentially.
See, as I
And
told you,
is it just going to be limited to South, or you intend to go beyond South in that case?
as I told you, we have identified South to start our journey. Today, if you look at our concentration of 54 stores, it's just out of 12 cities in South. We have a huge market to penetrate, and from the beginning, our entire focus on unit economics. Because of that, we have chosen, instead of being a pan-India brand, we have chosen a cluster model of penetration, meaning we have identified potential region and penetrated deep with multiple stores and formats to have that economies of scale kick in. And moving forward, next, with this IPO proceedings and next 2-3 years, our entire focus will be in South. But as I told you, with that background, I came from America and I have chosen South as my first destination. And as and when market, requires, when we find an opportunity, yes, we will expand anywhere.
A very pressing question that I guess most of the investor community would want to know about pledging. Because most of your proceeds actually also go towards catering to your working capital requirement needs, debt repayment to an extent. And there is also a 30% of equity which has been pledged. What explains that, and when do you expect to reduce that pledge?
So as I told you, I'm a first generation entrepreneur. We started our company with a very small scale. And apart from the initial investment, what we made, also we in last 17 years, we have flowed back entire, profits into the company. Cool. Along with this flowing back our profits and our initial capital, we also took the help of banks for our working capital, short term and long term funding. So generally what happens is, since we are a small company and a first generation, the bank, apart from their primary collateral, they insist to have a pledge on certain percentage of shares to have a control on the company, so that there is no special resolutions are passed without their attention or intention. So, and also, since there is no specific value attached to it before the listing, we always wanted to support the bank because they are supporting us. Moving forward, once we list, there would be a considerable value, and we have a strategy in place to get it depledged as early as possible. Because now also, because that will seen as very soon we started talking to the banks, because we also see that is as a concern.
Very soon, is it the end of this year? Is it going to be the start of the next year?
Probably in next 3-4 quarters we want to do that.
So year in that case, when you expect your 30% equity to be completely released from the pledge.
Address the concerns of the investors also. 30%
equity is a lot, and also one of the other parameter which I was looking at the RHP and came to my mind was the acquisition cost essentially of the promoter community being in the range of 5 to 19 rupees. There's a huge surge that we have seen in terms of the price band. What explains this kind of valuation, and what has changed for the company?
So see, if you look at as I told you, our primary investment when we did in the initial days. In 17 years back, we've been building our company from that. So obviously, we have started our journey with 10 crores. Today it is 1350 crores. The initial first year, 2-3 crores of profit. Now it is 97.5 crores last year. So obviously the company has grown. And if I have to give you a justification, if you look at our last year number, our P is 27%. You can compare with any other listed retailer. It's a way high than what we are trying to, because we always want to make sure something great left onto the table for our initial investors. So that's
exactly why I'm wanting to know why this appreciation after 17 years of you making the investment. What is the growth forward? If they're putting in their money right now and growing at a revenue CAGR of what? A 3-year revenue CAGR of 20%, given the pandemic impact too. In the next 3 years, how do you expect the revenue to stack up for investors to get any kind of...
we're going to add up 150,000 square feet in next 2 years.
What's the revenue projection with these stores?
So I think I should not talk about that.
But can you talk about the revenue CAGR being at 20%?
Yeah, I can say
for the last 3 years.
Yeah, pre-COVID we were growing as an average of 15 to 20% a year. So I think since that COVID normalization happened, and also we are trying to go into the most potential with our most powerful format, I think then you can do the math.
If you talk about
So in
average
that
revenue per
case-
square feet, it's 22,500 rupees per square feet, and we are adding about a 1.5 lakh square feet. I think that pretty much gives you an idea. And the most important part here is we are expanding through Varamahalakshmi format, and this Varamahalakshmi format is doing much higher than this average company's average. So doing that math, I think you should see a very good number of revenue coming from the next couple of years.
Bharadwaj, is that 20% growth rate, do you think you can replicate that year on year basis, or perhaps do a little more given the uniqueness of the model that you're suggesting?
I think what I'm trying to get to the point is we are doing much better than the today's average, so we should expect a great number of growth. I mean, we are in the most
more than
important
20%
milestone.
Maybe we cannot put a number out, as you know. We have certain.
You can expect a good growth, a
Right.
good double-digit growth is what you can expect. Probably.
double digit. No, see, it's like
We cannot make it triple digit, right?
I mean, if you really want to, then sure, you can
we
look at
want
it.
to promise, we want to say what is really practical. So what we are trying
So you
to tell
intend
you
to
is
is 20% year on year will be
we
we'll replicate it.
I can say it will be better than our pre-COVID, because our growth
Sure.
story will be more beautiful from the year on.
Okay, not putting numbers out there, which is a little bit of concern for me, but let's talk about your debt picture. How much does that come down to?
So it is presently 100 crores long term and 240 crores of short term. So out of issue proceedings, out of 600 crores, we are planning on paying back around 50 crores of long term. So post issue, it would be around 290. If you have to take a net of what we have today, 290 minus 45 crores of as a cash deposits, so it would be around 250 net debt post issue.
50 crore, and that will bring down your debt to equity, which is at 0.87 times to how much?
I have to do the math.
Okay, so 0.5 times
It
roughly
will come
around
down
that.
much lower, but if you talk about our next future, we will drastically bring down the debt because the entire working capital requirements.
You intend
that
to
we
be
need-
debt free at any given point of
We
time.
want it to be
By when?
Very
debt
soon.
free in a couple of years.
When you say
No,
couple
we
of
cannot
years,
say that.
maybe.
Again,
3
that puts
years,
up a
5
target.
years.
Very soon we are seriously planning,
Oh,
A
because
low
because
single
of-
digit is something that we could say. You can expect a debt free company soon.
Okay, all right. So that's the word. Of course, I'd want to understand your lowest inventory turnover as compared to that of your counterparts. What explains this? Is that a conscious strategy, keeping other parameters in place? How can one look
Two
at it?
things I want to say here. Number one regarding the industry, and number one regarding the competitors, whoever we are trying to refer to. See, here we are company owned, company operated. We don't have any franchises where our inventory lie in the books of franchisee, where that will be reflected as a debtors. If you try to take net of this thing, we are not far from anybody, any ethnic player, because ethnic industry per se, more the inventory, more the turnaround. We were talking about the 22,500 per square feet revenue. To get that, as especially in ethnics, when we talk about a sari, to sell one sari, we need to have at least 60 to 70 saris to be shown to our customer. And sari per se, it is originated from different geographies: Banarasi, Kanjivaram, Lucknowi, all this, and also different fabrics like silk, georgette, cotton, and different price points. So between all these things, we need to provide a huge collection and selection for our customers. And more importantly, the design and shelf life of our sarees are around 2.5 to 3 years, and one size fits all. So this particular model is designed, this industry, this ethnic industry per se, is designed to give that kind of options, choice, so that we can get that high productivity rate.
Sure, that still makes me come back to my same question. A, what is your mode? What is the uniqueness of your model? How do you stand out? And in terms of ROCs, of course, you've given some amount of guidance, but how do you stand out as compared to your peers in that case?
So, talking about our moat, I think it's safe to say that there are 3-4 points why we believe that we have a great moat and our right to win. The first and definitely the first more important reason is our 4 formats cater to the entire spectrum of the society, being it all occasions, all needs, we are there, and that's number one. The second important reason is definitely the cluster model. So because we always identify potential areas and we put more stores, what that does is help us give better large scale economies kicks in, our warehousing cost gets distributed, as well as our advertisement cost. So that has been our model that we have been following in the last couple of years. That's number two. And the third most important reason is definitely the technology. So today, if I have to tell you each and every product about the company that we sell in the company, we try to analyze with around 20 to 30 different variables. So this amount of data gives us great amount of insights in terms of what to buy, when to buy, where to buy, which store to put, and the churn. I mean, trying to move the stock from one store to the other store. These are a few reasons why, and not to also mention, I think our strong sourcing network. If you have to talk about it, our sourcing network is on north, south, east, west. Wherever a sari gets weaved, we try and tend to be there. So these are the four main reasons why we can always keep the competition at bay, and we believe that we do this meticulously with our dedicated teams to ensure that we are at the right balance of what we need to be, where we need to be. And
quickly, then last one question that I have for you, Bharadwaj, in that case you can take that up. In terms of the allocation to working capital requirement is roughly around 280 crore.
Correct.
You've also in the previous past borrowed from the banks for your working capital requirement, which has led to the pledging of your equity too. In future, how do you intend to utilize or probably raise money for your working capital requirement needs? Would that be through debt, or would that be for internal accruals? How are you looking at it?
so if we talk about our expanded capacity for about 30 stores, we are provisioned about 280 crores of working capital. So we as you know that we also have a great amount of money coming with internal accruals as well, because our current stores are also performing to the maximum capacities. So we do see a lot of releasing of the debt as we speak. And in terms of working capital, I think it's safe to say that because all of these 25-30 stores are coming in a cluster, because it's all coming in Tamil Nadu as a market, the core product for Varamahalakshmi Silks in Tamil Nadu is silk, and most of the silk weaving centers is all located in and around Chennai and Tamil Nadu. All of these tailwind factors will definitely enable us to improvise our inventory turnover ratios, as well as the internal accruals will definitely bring down our debt levels as we speak. You should be able to see a low single digit number within a year. Within those years, we should be able to become a debt free company soon.
But in going forward, the working capital requirements will be funded through internal accruals. Correct. Essentially.
Correct.
Once you become debt free, the guidance
it's
of
going
which
to be a sustainable model wherein it's a continuous feedback loop wherein the internal accruals should be able to help us.
2025 one can look at for the company being debt free and completely being able to fund in the working capital requirements.
To reiterate again, it's going to be a low single digit number. We aspire to do as early as possible, but unfortunately, as you rightly know, that this number I cannot put it out right.
Fair enough.
But you should be able to be more or less there.
All right, we'll just end it at that. And thank you so much for taking out the time and joining us in the newsroom this morning. All right, with this, it's a wrap. The company, the IPO, opens for subscription today, ends September 22. The price band is out there, and that's that. With this, it's a wrap and goodbye from the team. Thank you for tuning in.
Thank you.